56% of Americans over 50 don't choose when they stop working. Their employer chooses for them. And of the people who get laid off after 50, 1 in 4, 24%, never finds another full-time job. Not because they're not trying, because the hiring market in 2026 for a 52-year-old with 20 years of experience is genuinely structurally hostile in ways that the standard max your 401k and wait until 65 plan completely ignores. But here's the thing that makes this specific to you. Right now, at 48, there's a window, a real one. In finance, we call it a launch window, and it has a specific open date and a specific close date. And the decision you make inside that window is the difference between a retirement you designed and a retirement that happened to you. The decision is not, should I save more? Every video tells you to save more. The decision is structural. Are you building an income machine that still works if your employer decides you're too expensive next March? Because the data says there's more than a 50% chance they will. I've spent years running my own business, surrounded by accountants and fiscal lawyers who showed me how money actually moves at the level most people never see. I have multiple hundreds of thousands of dollars invested. I am not giving you theory. And what I'm about to walk you through is the exact framework that separates the people who exit on their terms from the people who exit in a panic at 53 when the severance letter lands on their desk. 4 things are working against you that the standard retirement plan doesn't price in. By the time we get through all 4, the math will be obvious, and so will the decision. There's a concept in aerospace called the launch window. If NASA wants to send a spacecraft to Mars, the planets have to be aligned in a very specific configuration. Miss the window, and you're looking at 2 years minimum before another opportunity opens. And the correction trajectory costs you enormously more fuel, more time, and more precision. You don't get to make it up later. You get a worse version of the mission, launched from a weaker position. At 48, you are inside a launch window. The planets are maximum earning years, access to tax advantage contributions, compounding runway of 17 years to 65, and still enough time to build the right structure. All 4 of those planets align right now. They stop aligning around 54 or 55, not because the math changes, but because forced exits, healthcare pressure, and sequence risk start narrowing your options faster than contributions can compensate. Every time something in this video connects to that reality, I want you to hear it as the launch window. That's the frame. That's the decision. Let's get into why. In a few minutes, I'm going to show you a number about Social Security that most 48-year-olds have never seen framed correctly, and it completely changes the timeline math. But first, let me show you why the plan you currently have breaks exactly when you need it most. The story most people in their late 40s tell themselves about retirement goes like this. I'll keep working, I'll keep contributing, I'll retire sometime between 62 and 65. That's the plan. ProPublica did a landmark analysis on this. They tracked actual workers from their early 50s through retirement, following them through the data. What they found, 56% of workers over 50 are either laid off, pushed out through deteriorating conditions, or forced to leave jobs for health or caregiving reasons before they intended to retire. More than half. Not unlucky people. Not people who made bad choices. The statistical majority of American workers who enter their 50s with a job they intend to keep. And here's what happens next. According to a Wall Street Journal analysis of Boston College's health and retirement study data. Among Americans aged 50 to 65, 14% were laid off at least once in a 10-year period. Of those who experienced a layoff, 24% never found a new job. Not took longer to find one, never found one. And of those who do find new employment, economist Kevin Cahill's research shows they take on average an 11% wage cut. So you survive the layoff, you get back into the workforce, and you're earning 11% less at the exact moment you need to be saving at maximum velocity. Then there's the ageism data, which is where it gets genuinely uncomfortable. AARP found that 64% of workers over 50 have witnessed or experienced age discrimination in the workplace. Glassdoor reported in early 2025 that mentions of ageism in job seeker comments had jumped 133% year over year in the first quarter of that year. And according to Fortune, 22% of employees over 40 say their workplaces skip older workers for challenging assignments, while 16% have witnessed a pattern of being passed over for promotions in favor of younger staff. None of this is new. What is new is that the rate of disruption has accelerated. The average job tenure for a worker over 50 is not what it was in 1995. The restructuring is faster, the AI-driven workforce reduction is real, and the companies doing the cutting are not discriminating against people they like. They're optimizing against salary lines on a spreadsheet. Think about what this means for the standard financial plan. The plan that says, stay employed for 17 more years, max out contributions, and retire at 65. That plan has a single point of failure. It requires your employer to value you continuously for 17 more years. And the data says you have a better than even chance of hitting a forced exit somewhere in that window. This is not a reason to panic. It's a reason to change the structural decision you make this year. There was a guy, call him Marcus. He was 51 when his company's software division was restructured. 12 years as a senior engineer. Strong reviews, never a write-up. He had $220,000 in his 401k and a plan to retire at 63. The day the layoff notice arrived, his plan became a fantasy. He was out of work for 8 months. The next job paid 18% less and didn't offer a match. He never recovered the savings rate he'd had before. At 48, Marcus had been doing everything the standard advice told him to do. What he hadn't done was design an exit that didn't require his employer's continued participation. I'll come back to what Marcus did next, because this story has a second chapter that actually matters. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. The second thing working against you is something I call the invisible bill. And it's the number that kills more early retirement plans than any single investment mistake. The bill is healthcare. Specifically, the gap between when you stop working and when Medicare starts, which is 65, full stop for almost everyone. Here is what health insurance actually costs in 2026. If you leave your job before Medicare and you miss the income thresholds for ACA subsidies, according to Smart Asset's 2026 analysis, the average benchmark marketplace premium for a 62-year-old is approximately $1,072 per month. That's $12,864 per year per person. Before your deductible, before co-payments, before any actual medical events. And here's the 2026 specific problem that almost no one is talking about. The enhanced ACA subsidies that existed from 2021 through 2025, the ones that had been making marketplace insurance dramatically more affordable, expired at the end of 2025. They are gone. The subsidy cliff is back. If your modified adjusted gross income exceeds 400% of the federal poverty level, which is roughly $62,600 for a single person in 2026, you lose all marketplace subsidies. Not some, all. Your premium could more than double compared to 2025 for the exact same coverage. This is not a hypothetical. It is a structural change to the cost of early retirement that took effect this year, right now, and almost no one who did their retirement math in 2024 has repriced it. For a couple, both retiring at 62, you could be looking at $2,000 to $2,400 per month in premiums alone before a single bill, before a single procedure, before medication costs, and medical inflation has historically outpaced general inflation. This isn't a static cost. It grows. The full retirement healthcare picture is even larger. Fidelity's 2025 retiree healthcare cost estimate says the average 65-year-old who retired in 2025 will spend $172,500 on healthcare and medical expenses throughout their retirement, and that's after Medicare starts. According to a 2026 report from EBRI, some couples may need up to $469,000 in savings specifically to cover healthcare and retirement. To have a 90% chance of covering those costs, a man needs $212,000 set aside just for healthcare. A woman needs $252,000. The standard retirement calculator does not include this line item. The plan you're operating on probably does not include this line item. And the 48-year-old who builds a portfolio targeting the magic retirement number, which Northwestern Mutual's 2026 Planning and Progress study says Americans believe is $1.46 million, and doesn't separately account for $12,000 to $13,000 per person per year in pre-Medicare insurance costs, has just discovered an invisible hole in the bottom of the boat. The hole doesn't exist until you stop working. Then it very much exists. This is where it gets really interesting, because the problem is not just the cost. The problem is the income trap. If you retire before 65 and start drawing from your traditional 401k, those withdrawals count as ordinary income for ACA subsidy purposes. If you draw too much, pushing your income above $62,600, you lose the subsidies. If you draw too little, you can't cover your expenses. The narrow band in between requires precision planning that most people haven't done. The people who navigate this successfully do it by building Roth accounts, because Roth distributions don't count toward modified adjusted gross income. They can draw from Roth sources to fund their lifestyle while keeping their taxable income low enough to retain ACA subsidies. That's not a trick. That's deliberate tax architecture built years in advance. This is what I mean by the launch window being structural, not just numerical. Knowing these numbers and actually building a system around them are two very different things. I've had this data for years. For a long time, it sat in a folder on my laptop as interesting statistics that I couldn't act on because I didn't have a framework that connected them. That's why I built a digital book called The Exit Code. It's 8 chapters of pure research, no filler, nothing inspirational, built on 50 years of actual retirement data and distilled into a mathematical framework for figuring out exactly when you can stop depending on a paycheck. 2 pieces connect directly to everything I've just explained. The first is what I call the $14,000 invisible bill, the precise calculation of the insurance gap that quietly destroys early retirees under 65, including the income management strategy, to stay below the ACA subsidy cliff in 2026. The second is the 4% trap, a rigorous look at why the standard safe withdrawal rate breaks down in the first 5 to 7 years of retirement, and what the dynamic withdrawal method does differently when the market opens. Badly. If you found value in this video, the full framework is available through the link in the description for less than what you'd spend on one dinner out. Every year you delay running this math compounds against you. Let's talk about the third thing working against your current plan, and this one is genuinely counterintuitive. Social Security is a math problem, and almost everyone is solving it wrong. Here's the number. If you were born in 1978, your full retirement age is 67. Claim Social Security at 62, and you receive 30% less than your full benefit, locked in for the rest of your life. Wait until 70, and you receive 24% more than your full benefit. Stack those 2 facts together, and what you get is this. Workers born in 1960 or later can increase their monthly Social Security income by 77% by claiming at 70 instead of 62, 77% on a guaranteed, inflation-adjusted, government-backed income stream. You cannot buy that return in any legitimate market. For reference, Kiplinger calculated that in 2026, the difference in maximum Social Security benefits between claiming at 62 versus waiting until 70 is $2,212 per month. Every single month for the rest of your life. That is not a rounding error. What does the data say people actually do? More than 20% of newly awarded retirees claim Social Security the moment they're eligible at 62. Less than 10% wait until 70. 9 in 10 working Americans tell Schroders researchers they plan to claim before age 70, with 70% of them acknowledging they know waiting produces a higher payment. The knowledge exists. The behavior doesn't follow it. And it got worse in 2025. AARP reported that from January through July of 2025, more than 2.3 million people filed for Social Security retirement benefits, up 16% from the same period in 2024. The Urban Institute, which tracks this data, called it a reversal of a decades-long trend. Even higher earners who have the most financial flexibility to wait were claiming at 62 at elevated rates. Why? Fear. Specifically, fear that the Social Security Trust Fund is going to run dry and they want to lock in benefits before that happens. Here's what the actual trustees report says. According to the official 2025 Social Security Trustees Report, the combined trust funds are projected to be depleted by 2034, after which continuing income would be sufficient to pay 81% of scheduled benefits. More recent analysis from the Committee for a Responsible Federal Budget, accounting for recent legislative changes, puts the OAC retirement trust fund's insolvency date at 2032 with a 23 to 24% automatic benefit cut if Congress fails to act by then. Here is what that actually means for a 48-year-old making an early claiming decision today. If you claim at 62 and the trust fund is cut by 23% around 2032, which would happen in the window, when you're 66, you would be receiving 23% less on top of the 30% you already gave up by claiming early. That is not a hedge against trust fund insolvency. That is maximizing the damage from it. The people who get hurt most by a Social Security benefit cut are the ones who already claimed early and locked in a reduced base. The people who get hurt least are the ones who built a portfolio that didn't require them to claim early, who waited until 70 and maximized their base before any potential cuts. This is the Social Security bridge problem. You don't solve it by claiming early. You solve it by building a portfolio at 48 that can fund 2 to 3 years of living expenses without Social Security. So you have the flexibility to claim at 67, 68, or 70, depending on the circumstances. You cannot build that bridge when you're 63 and just got handed a severance package. You build it now. Now let me tell you about the thing that will quietly destroy a retirement that's otherwise mathematically correct. And this is where Marcus's story becomes genuinely useful. Two twins retire on the same day with a $1 million portfolio each. Same allocation, 60% stocks, 40% bonds. Same withdrawal rate, 4% or $40,000 per year. The only difference is the year they retire. Twin A retires in January of 2000. Twin B retires in January of 2012. Twin A's first 3 years are 2000, 2001, and 2002. The S&P 500 falls 49% from peak to trough during that period. The dot-com crash, Twin A's portfolio is getting hammered while he's pulling $40,000 per year out of it. By the time markets recover in 2003, Twin A doesn't have $800,000 working for him in the recovery. He has something substantially less because he sold shares at depressed prices every quarter for 3 years to fund withdrawals. The losses weren't theoretical, they were permanent. According to research examining this exact scenario over 20 years of data, many of those 20-year retirees found their portfolios never fully recovered to their original value, despite the strong bull markets that followed, because the early withdrawals during a down market reduced the base from which future gains could compound. Twin B retires in 2012. The S&P 500 returns 32% in 2013 alone. His first year of retirement features a massive tailwind. His portfolio grows while he withdraws. By the time a bad year arrives, it's working from a significantly larger base. Same average return over 30 years. Same withdrawal rate. Same allocation. Completely different outcome. The timing of which years get the bad returns is the variable neither of them controlled. This is sequence of returns risk, and it is the single most underrated structural threat to a late 40s retirement plan because it is invisible during the accumulation phase. When you're 48 and your balance is going up, you have no way of knowing whether your exit will land in a 2000 window or a 2012 window. Nobody knows. It's not a market timing question. It's a structural design question. The answer is not pick better years to retire. The answer is design your withdrawal system so that a bad opening sequence doesn't permanently impair your portfolio. What that specifically looks like is a cash buffer, 2 to 4 years of living expenses held in short-term bonds or cash equivalents not invested for growth, invested for stability. The purpose is not to earn high returns. The purpose is to avoid selling growth assets in a down market in the first years of retirement. If the market drops 40% in your first year and you have 3 years of expenses in a cash bucket, you spend the cash. Your equity portfolio is untouched. It recovers. If the market is up that year, great. You refill the cash bucket from the gains and everything continues on schedule. This buffer cannot be improvised at 63. It has to be part of the accumulation plan years in advance, which is another way of saying it has to be part of the decision you make at 48. And there's one more hidden cost that belongs in this conversation because it interacts with sequence risk in a way that multiplies the damage: fees. Specifically, the fee drag from a 1% a year advisory fee on an actively managed portfolio versus a low-cost index approach. Here's what 1% per year over 30 years actually costs. A $500,000 portfolio growing at 7% gross with no fees grows to approximately $2.71 million over 25 years. The same portfolio at 6% net after a 1% advisory fee grows to approximately $2.15 million. That's a $560,000 difference from the exact same starting portfolio, earning the exact same underlying return. The only variable is cost. And according to analysis from financial planning data, a 1% difference in annual fees can reduce your portfolio's final value by 28% over a 30-year period. Not 1%. 28, because fees compound in reverse. Every dollar that doesn't compound because it was paid in fees is a dollar that doesn't generate additional growth in subsequent years. In retirement, this is worse. During accumulation, you're adding new money that partially offsets fee drag. In retirement, you're withdrawing, not adding. Fee drag during withdrawal interacts with sequence risk in the worst possible way. Two forces working against the base simultaneously. The mathematically sound decision at 48 is not hire an active manager and hope they beat the market. The data on that across decades is unambiguous. The vast majority of actively managed funds underperform their benchmark index after fees over 15-year periods. The lazy portfolio, diversified, low cost, rebalanced annually, has historically outperformed active trading approaches over 30-year windows. Not in every year, across the full window, which is the only window that matters. Now let me come back to Marcus. After 8 months of unemployment and a new job that paid 18% less, Marcus made 3 specific decisions that he hadn't made at 48. First, he started a Roth conversion ladder. While his income was temporarily lower from the pay cut, he converted chunks of his traditional 401k balance into a Roth IRA each year, paying tax at a lower marginal rate than he would have paid at his previous salary. He was buying tax-free future income at a discount. 5 years of that, consistently done, created a meaningful Roth balance that he could access in early retirement without triggering taxable income and without touching his ACA subsidy eligibility. Second, he opened a taxable brokerage account, not for speculation, for liquidity, assets he could access before 59 and a half without a 10% early withdrawal penalty. It grew slowly at first, but the structural flexibility it gave him the ability to fund a year of expenses from a taxable account rather than raiding his retirement accounts at the worst moment was the difference between an early exit and not. Third, he restructured his portfolio around a 2-bucket withdrawal system. He built 3 years of living expenses in short-term bonds and cash equivalents. He called it his sequence buffer. If the market opened badly when he retired, he had 3 years of runway before he'd need to touch his equity portfolio. If the market opened well, the buffer just stayed full while the equity portfolio ran. None of these were complex or exotic. They were the decisions a 48-year-old should have made and didn't, which is why I'm telling you the story. At 54, Marcus is in a better structural position than he was at 51, despite the pay cut, the gap year, and the lower match. Because the framework he built after his layoff is the same framework someone at 48 could have built before one. The difference is whether you're building it from strength or from desperation. Let me run the actual numbers on a specific person to show you what this looks like in practice. Dave is 48. He earns $120,000 per year. He has $190,000 in his 401k. He contributes 7%, $8,400 per year, and gets a 3% employer match. So total annual contribution is about $12,000. He owns a house with roughly $250,000 in equity. No other significant investments. By Fidelity's benchmark, Dave should have approximately 6 times his salary saved by age 50. 6 times $120,000 is $720,000. He's at $190,000. He is not on track by a significant margin. But here's what the numbers actually look like if Dave makes a structural decision this year. The 401k contribution limit in 2026 is $24,500. Dave's current contribution is $8,400. His employer matches on the first 3%. If Dave increases his contribution to the maximum $24,500, his employer still contributes $3,600. Total annual contribution becomes $28,100. Over 17 years, at a 7% average annual return, his current balance of $190,000 grows to approximately $562,000. His new maximum contribution stream, $28,000 per year, compounding at 7% for 17 years, adds approximately $840,000 more. Dave's projected balance at 65, approximately $1.4 million, right at his target number. And that's before any home equity, before any Social Security income, and before any outside accounts. Now he makes one more decision. He opens a Roth IRA. In 2026, he can contribute up to $8,600 as a couple, assuming income qualifies. Over 17 years at 7%, that's an additional $240,000 in Roth dollars, tax-free on withdrawal. That $240,000 is what funds the income management strategy that keeps him below the ACA subsidy cliff between retirement and 65. Let me be precise about the impact. If Dave retires at 62 and draws 4% from his traditional 401k balance, he's pulling roughly $56,000 per year in taxable income. That puts him close to the $62,600 ACA subsidy cliff. By drawing from his Roth IRA instead for 1 or 2 of those years, or by drawing partially from each, he can keep his modified adjusted gross income under the threshold and maintain ACA subsidy eligibility. The difference in monthly health insurance premiums between qualifying for subsidies and falling above the cliff is potentially hundreds of dollars per month, possibly over $1,000 per month, depending on the plan. That is the launch window made concrete, not save more. Structure it correctly, starting now. There's also the comedic version of this, because it deserves to be named. The average American thinks they need $1.46 million to retire comfortably. Northwestern Mutual's 2026 Planning and Progress study confirmed that number. The average 401k balance across all ages in 2024, according to Vanguard, was $148,153. The median, meaning the number that represents the typical saver, was $38,176. So the plan currently in motion for the median American is to close a gap of approximately $1.42 million between where they are and where they need to be by continuing to save what they've been saving in the way they've been saving it without changing anything structural. That is not a plan. That is optimism with tax advantage wrapper. The solution is not to panic. It's to recognize that the decisions made between 48 and 53 have a compounding leverage that no other period in a working person's financial life has. Not because the math is different, but because this is the last window when you have both the income to fund the structure and the time for the structure to compound. Every year you wait to maximize contributions, you are not just losing 1 year of savings. You are losing 1 year of compounding on every dollar you could have contributed. According to calculations on fee drag and contribution timing, a dollar contributed at 48 compounds for 17 years at 7% and becomes approximately $3.20. The same dollar contributed at 53 compounds for 12 years and becomes approximately $2.25. The contribution doesn't change, the compounding window does. So here is the practical framework. 3 levels. Each builds on the last. Level 1 is the savings rate floor. If you're not contributing at or near the maximum to your 401k, you are leaving the most powerful tax-advantaged accumulation tool available on the table during your peak earning years. In 2026, the maximum contribution is $24,500 for those under 50. When you turn 50, the limit rises to $32,500, including catch-up. That $8,000 catch-up contribution available after age 50 added to the base limit is one of the most genuinely valuable and consistently underused provisions in the entire tax code. People treat it like a nice to have. 5 years of maximum catch-up contributions, compounded forward at 7%, can add substantially to a retirement balance that looks short at 48, but not at 55. Level 2 is tax architecture. Specifically, build retirement savings across at least 2 different tax buckets. Pre-tax traditional accounts, your 401k, grow tax-deferred, but generate ordinary income on every dollar withdrawn. Roth accounts grow tax-free and can be withdrawn without triggering taxable income. The reason this matters is income control. When you can choose which account to draw from in any given year, you can manage your total taxable income with precision, staying below the ACA subsidy cliff in early retirement, managing Medicare IRMA surcharges later, and reducing your effective tax rate throughout the withdrawal phase. People with only a traditional 401k have zero income control in retirement. Every dollar out is ordinary income. Every dollar counts against ACA eligibility. That inflexibility is expensive, and it's manufactured by the decisions or non-decisions made in the accumulation years. Level 3 is sequence protection. Build a cash or short-term bond buffer, 2 to 4 years of living expenses, specifically intended to provide withdrawal runway in the event markets are down in the first years of retirement. The purpose is not return. The purpose is to prevent forced selling of growth assets at depressed prices during the phase of retirement when portfolio damage is most permanent. This buffer cannot be improvised in the 6 months before you retire. It has to be part of the accumulation plan, meaning it has to be part of the structural decision made now. None of these 3 things are complicated. All 3 of them require starting at 48, which is exactly where you are. The launch window. It opens, it closes. The next one arrives from a weaker position at a higher cost. At the beginning of this video, I told you that 56% of Americans over 50 don't choose when they stop working. Here's the practical conclusion from that data. You probably have somewhere between 7 and 17 years of active employment remaining, but you don't know exactly how many, and neither does your employer. The system you build this year is the one you'll either have or wish you had at 53 when the restructuring memo lands. That gap between have and wish you had is not a number. It's a decision. Takeaway 1, maximize contributions now with specific attention to what happens the year you turn 50. The catch-up provision that unlocks at 50 is not a minor adjustment. Combined with the base limit, it allows $32,500 per year into your 401k in 2026. 5 years of that, compounding at 7%, is the mathematical difference between a retirement that works and one that requires you to delay until 67. Takeaway 2, build tax architecture before you need it. Open a Roth IRA this year if you haven't. Begin Roth conversion ladder conversations if your income allows. Start a taxable brokerage account for liquidity. This is not about the returns on those accounts. It is about having income control in retirement that the standard all-traditional 401k approach simply does not give you. Takeaway 3, design the exit, not only the accumulation. Know your sequence risk buffer number, how many years of living expenses you need in stable, non-equity assets at the point of retirement. Know your Social Security bridge strategy, what your portfolio needs to look like to give you the option of waiting until 67 or 70. Know your pre-Medicare healthcare number for the gap years. These are not questions to answer at 62. They are calculations that change the structural decisions you make today. Lazy investing built more fortune than crypto memes. The market does not reward the people who chase the most exciting thing in the room. It rewards the people who build the most durable structure and leave it alone long enough for compounding to do what compounding does. The 48-year-old who maximizes contributions, builds tax diversification, and designs a withdrawal system with a sequence buffer will, over 17 years, arrive at a position of genuine optionality, the ability to exit when they choose, not when they're forced to. The one who doesn't will arrive at 62 dependent on a single employer who has a financial incentive to replace them with someone younger and cheaper. The window is open, the planets are aligned, the decision